speaking and only the person speaking, please click the middle rectangle that is located above the top speaker. I will now hand you over to Craig Hanks, who will begin today's presentation.
Thanks, Kelly, and welcome again to everyone attending today, and thanks for taking time out of your day to come and see the webinar. So today we're talking about key funding issues and opportunities, and my particular aspect of this webinar will be debt financing and applying for debt finance through funding submissions. For those of you who aren't familiar with RSM, I suspect a lot of the people in the webinar will be, but we're a full service accounting firm located in all major locations around Australia, and as you can see from the map there, a lot of regional locations as well, and well over 1,200 staff nationally. I'm a principal in the corporate finance team. Our service lines include obviously the topic of today, which is debt advisory, transaction support, and due diligence, and they're the two areas that I specialise in. We also have a specialist financial modelling team, mergers and acquisitions advisory, valuation, and capital markets, as well as litigation and forensic support. So the topic today is how to prepare a funding submission, or things to think about as you're preparing a funding submission. And it's probably remiss if we don't cover the current environment sort of up front. Obviously, a lot of things have changed in the last couple of months with COVID-19, and different industries are obviously going through different experiences with the current situation. So things to consider for the current environment when we're talking about funding submissions. One of the first things that comes to mind really is, do you have a business continuity plan in place? And I know that that's something that Aleks from EIFC I was chatting with her the other day ahead of this webinar, and that's something that they look for in terms of assessing a business's readiness for funding. So is there a business continuity plan in place, and how are tracking now against that plan? I'm obviously doing this webinar today from home, so I imagine most people are the same, and they've had to move their workforces to work remotely. That's usually part of a business continuity plan, etc. So that's one of the first things to think about. In terms of cash flow, and I'll be going into a lot more detail on cash flow forecasting shortly, but we normally recommend that businesses forecast on a monthly basis over a medium to long term. But in the current environment, consider whether a weekly forecast is relevant for internal use, and also perhaps to provide to a bank as part of monitoring lending. In terms of funding submission in the current environment, we need to think carefully about when our business will return to normal, and I've got normal in quote marks there. So that we don't really know what normal necessarily will mean in the future, but by speaking to customers, suppliers, and other stakeholders, speaking to your sales reps or other members of the management team, hopefully we can put together an informed judgment, or in other words, a calculated guess in terms of how and when things start to return to normal. And any lender in this scenario, in this situation, is going to be very interested in the work that you've done behind that. You might need to run some more scenarios than you normally would to understand the range of future outcomes. And also, lenders are going to be interested in your access to the various assistance packages provided by government during COVID-19. And we'll talk about the financial model later, but can the model incorporate those, or can be modified? So in terms of preparing a funding submission, what we do for our clients normally is to prepare an information memorandum, and that's simply a document that outlines the requirement for the funding and provides pertinent details about the business. I know that EIFC can often request a business plan, and a business plan and information memorandum are very similar documents. The difference really being that an information memorandum is completely tailored to the purpose of raising funds, in this case debt funds, but very similar in terms of content. If you are going to go forward with a business plan, I'd just suggest that you review the business plan carefully and make sure that all the information in the business plan is relevant and tailored for the purpose that you're going to be using it for with a bank or EFA. So the first, what I'll do is I'll just run quickly through the type of content that we put into an information memorandum for our clients when approaching a bank. And the first thing really is to be clear about the objective of the funding. So how much are you seeking? And being very clear on the use of funds. So is it for working capital? Is it for expansion, or is it simply a refinance? So if you've got new projects coming up, you need to maybe invest in inventory or equipment, or perhaps employees, bringing on new employees, and that's important detail that any provider of finance is going to want to understand. And also nominate a proposed tenure of the funding. Obviously, the bank will have a view on tenure and amortisation, etc. But really important that you've had to think about that in advance. Then we move on to business background, and in terms of a background and a document for funding, I'd really advise that the background of the business is relevant to the purpose that we're using it for. So we don't necessarily need to go back over the full history of the business. I think what we're really looking to do here is to articulate the business model and the business strategy. Often in business plans that we may see from time to time, particularly in the technology related sectors, we can sometimes read a business background and not really perhaps have a great grip on what the business actually does when we're finished reading the background. So really important that people from outside the industry can understand the business model and the strategy. Need to include a corporate structure diagram, of course, so that the bankers can understand the structure and what they're actually lending into, and at what level they might be lending into at the corporate structure. An org chart and employee numbers and details is fairly standard. The next section we generally include would be major products and services. So the bank is going to be really interested in understanding the revenue model, and again making sure that revenue model is understandable from someone coming from outside of the particular industry. Always of interest is the level of recurring and contracted work or projects, rather in comparison to non-recurring and non-contracted. And to the extent that there is no recurring or contracted revenue, really explaining why that's the case, and perhaps focusing more on customer relationships and the surety of that revenue going forward. Certainly one that's relevant in today's context with Aleks presenting after myself, really looking at key markets and geographies. So particularly where there's international exposure. So segmenting revenue by markets and geographies, and also thinking about not only where the sales are being made, but where the supply chain is. That's important information for a lender to understand exactly how their funds and where their funds are going to be used. Not so much of an issue with EFA because they're specifically set up for export finance, but you'll find some of the major banks we need to go into a lot of detail about international operations, and as a general rule, they're probably more comfortable lending domestically. Key customers. So who are the key customers? Obviously, where we've got blue chip customers, we want to be highlighting that. That gives lenders some comfort over the customer's ability to continue to purchase our products or services and to pay their invoices on time. Look at customer terms, and a big one is generally customer concentration. So in an ideal world, we'd have a diversified customer base. Often, if we're talking about mid-market businesses, which is where I predominantly service the mid-market, often that's not the case, but there's often mitigating factors there for mitigating against the key customer risks if the customer base is somewhat concentrated. And particularly during COVID-19, making sure that we understand our customer base and we're on top of any customer risks. Similar for key suppliers, who are the key suppliers, and what contracts do we have in place for critical suppliers or alternative suppliers, and again addressing any supplier concentration needs. Banks will obviously be concerned that if something happens to a supplier in this current environment, what are our alternatives? And then focusing on on the key personnel. So some brief CVs, but I think it's important that in a funding submission that we outline the key strengths of the management team. Bankers are always interested in the quality of the management team, and certainly the quality of the information you put forward in a funding submission is a reflection on the capabilities of the management team. So I'd like to probably spend a bit of time looking at the financial information component of a funding submission. It's of critical importance in terms of a lender's ability to assess the viability of a lend. Quite often, when we speak to clients and they're looking at putting in a funding submission, perhaps before we've got involved, often that will mean a bundle of historical accounts and some management accounts, sort of bundled up and attached to maybe a business plan. We prefer to take that historical information over the last 3 years and the current year to date in terms of the profit and loss balance sheet and cash flow, and we like to take that and present it as a packaged up set of information. So we'll have year on year comparable analysis, and that's really important because it's a lot easier for someone reading an information memorandum to look at financial information that's been prepared specifically with their needs in mind, rather than sifting through lengthy management accounts and annual financial accounts. We need to consider the one-off and non-recurring items that often crop up over the historical period. So, if there's been maybe a loss of a customer that's impacted revenue for a particular year, we need to really call that out and explain why that's impacted. Likewise, if we've had a one-off order that has increased revenue in a particular year, need to call that out and show that perhaps that's not indicative of the business going forward. Any other perhaps restructuring costs or the like need to be called out and explained. And finally, a breakdown of the balance sheet and particularly the working capital profile. So what we like to do is present a 12-month to 2-year trend on working capital, including the major movements in the major components of working capital, and calling out any particular working capital trends, seasonality, highlighting any particular working capital needs that are arising out of the historical performance. And then it's really important to provide some insightful analysis, again, so that the bankers can see, the credit teams at the banks can see exactly, can see behind the numbers, so they've got some insight into the underlying business performance. So forecast financial information is key to any funding submission. Again, often if we see what clients are sometimes putting forward to lenders, it's often maybe their budget information, and again we prefer to prepare information that's specifically tailored for the purpose we're using it for. And in this regard, a 3-way integrated model is really best practice for funding submissions. And by 3-way integrated model, what I mean is the output of the model is a P&L, a balance sheet, and a cash flow that are integrated and work together, just like a set of historical financial statements do, and therefore that it's transparent and robust in terms of if there's a change in the P&L assumptions, and that will automatically flow through the balance sheet and cash flow. Typically, we look at monthly forecasts going out somewhere between 2 to 5 years. But in the current environment, as I said, consider the need to provide potentially weekly information in the short term. Excel-based models, in our experience certainly work best. We prepare our models in Excel. I know there's some software out there in the market that we see crop up from time to time. But in our experience, Excel is the best way to build a model in terms of making the model dynamic and having an assumption driven and having flexibility in the model. The fact that it's in Excel sometimes causes people concern about the robustness of the workings of the model, but in our experience, where we've got experienced financial modelers working on the engagement, Excel is certainly the best way to go. As best practice, assumptions, the model should be assumption driven and formula driven. We really like to keep hard-coded numbers well away from the model. Certainly there'll be some hard-coded numbers in the assumptions, but when it comes to calculations and the outputs, there should be no hard-coded numbers. The reason for that is that if we need to adjust, or when we need to adjust the model and use it flexibly, once we've put hard-coded numbers in, it's easy to forget about those hard-coded numbers, and we can start getting some strange results as a result. We build the model around the key drivers of the business. So this is really about finding a balance between the right amount of detail in the assumptions on the key drivers of the business. So putting the time and energy into making sure that the things that really count, that we've put the right amount of modelling into the model. Overlay the new funding structure. So certainly initially we may not exactly know what the funding structure is going to be. That'll obviously be ultimately determined by negotiations with the lender. But it's always good to the lender to be able to see that debt structure overlaid. Make sure the model's easy and logical to navigate. I've got a bit of an example of a presentation dashboard in a couple of slides' time. But that's useful to be able to quickly assess the forecast of the business without having to delve into the detailed model. Certainly in these times, a model that's easy to sensitize and run scenarios is critical. And one of the most important aspects of the entire forecast process is a proper review process. So for instance, in our modelling team, we will always have a member of the team who isn't involved in that particular engagement to do a full review of the model before it gets handed over. In terms of model components, a best practice model will have assumptions that will drive the model. So you change an assumption and that will result in an appropriate change to the outputs. And that the assumptions need to cover off historical information. So we've got an opening balance sheet position. Obviously the critical P&L assumptions, the balance sheet assumptions, including working capital and a debt overlay. Calculations will be the part of the model where all the calculations will take place and basically be the conduit from the assumptions to the output. And reporting can be really tailored to suit the end user. So usually there's an annual financial statement dashboard, monthly financial statement dashboard, but then relevant charts in terms of covenants and ratios. So this is just an example of a dashboard. We wouldn't normally put all this information onto one screen, but I've just sort of copied and pasted the various financial statements just into one slide so that we can get it all into one slide. This is actually an example from a template model that we have put together specifically to assist our clients in this current COVID-19 circumstance. So you'll see there on the right-hand side under cash flow, there's specific provision there for JobKeeper payments, etc. So this is a model that we can use to assist our clients to get up and running with a financial model really quickly without having to do a whole lot of background modelling work. In addition to this, we'd normally have some working capital charts, some cash flow charts, etc., to really help paint a picture for the end user. And just finally, before I hand over to Aleks, we have put together a financial model checklist that we use when we're talking to clients about their financial forecasting capabilities. I've probably gone through a lot of these points already, but there's a couple I'd like to pick out. So points 2 and 3 there with the tick marks, clear line of sight to underlying historical results, and does the unwind of the opening balance sheet fit with historical trends? I thought it was useful calling this out because what we often see when we build a model, we've been given assumptions by the client of what the client thinks that the business assumptions look like. We've got an opening balance position, and when those assumptions are applied over the first, say, 3 to 6 months of the model, sometimes we can get some fairly strange results. And it's a really good indicator to go back and review the modelling assumptions and the way the model works to make sure that that unwind of the opening balance sheet looks sensible. It's one of the key checks before releasing the model to the end user. Make sure the model addresses the lender's needs. So make sure the model can reflect an updated term sheet and incorporate covenants and KPIs that might be required. Another practical item here, which I think is worth calling out, is can the model be rolled over to refresh the start date? Often when you start a process like this, you'll use a set of historical numbers as your starting point. You'll then start a forecast period. By the time we get to perhaps the last round of due diligence by a funder, things may have changed a little bit, and they may require the model to be updated. If we can build the model at the start with that in mind, it means that maybe it takes a couple of hours to refresh the model rather than a couple of days to sort of rebuild components of the model. And then right at the end, we just need to make sure we're doing high-level checks. So yes, we can go through and make sure the model has integrity and the calculations work, but do the assumptions and calculations result in a forecast that looks sensible? We often see on the first cut of a model, there might be some sort of runaway working capital balances that, we can see the debtors, for instance, are way too high compared to historical, and we can't explain it. So it just means we need to, again, go back and review the assumptions and make sure that the model actually, the output of the model actually reflects the reality of the business. So that concludes my part of the webinar today. I look forward to answering any questions you've got at the end. But I'll now hand over to Aleks to hear more about EFA and their offerings.
Thanks, Craig. Good to be part of the team here today, and really appreciate the insights you're sharing. It's very relevant to what we are looking at the moment, so appreciate the RSM's invitation to participate today as well. I think we were originally planning to have a boardroom lunch in Perth with a number of clients and sort of roll out a bit of what we do, what you guys do. However, times have changed very quickly, and we're all sort of operating out of our studies and our bedrooms. A little bit in more of a comfortable clothes than what we normally used to in these sort of events. So I'm personally very much looking forward to recommencing these events face to face, and hopefully that normality comes back sometime soon. So applying for finance at the best of time, as you may all appreciate, can be a very daunting exercise, and not to mention very frustrating. We hope that today's presentation will sort of shed some light in terms of what Export Finance Australia does, how to provide that clarity, what those next levels of requirements look like, and how to work with your CFOs, how to work with your accountants, how to work with, advisors through RSM to, pre-position these funding requests in the best possible light. So today I will just move on to my slides, sorry. Few seconds, here we go. So today I will cover off 7 key slides, so it won't be too much death by PowerPoint, and 5 key areas of those coverage is going to be who Export Finance Australia is, previously known as EFIG, what businesses we can support and how we provide that support. We've got allocation of $500 million recently announced by our Minister for Trade, Tourism and Investment, Simon Birmingham. So COVID-19 Export Capital Facility, what does that look like and what does that mean for you? How we actually do lending assessment risk and, what we go through. And a lot of that has been covered off in Craig's presentation. So I'm kind of grateful that level of detail has been covered off. And some of the examples of businesses and clients that we have supported across a number of different industries, just to sort of put a little bit of context to what we do. So who are we? Export Finance Australia, for those not familiar with the new name, which recently changed, we used to be known as EIFC. We have been around for 60 years and we are federal government's export credit agency. We are headquartered in Sydney and are an agency of 100 employees with representatives in each state. So for WA, we've got myself as a director for the state and also my colleague Cameron Hall, who's been around for about 3 years now and knows a lot of people in industry, especially in WA, and you might have been familiar with his name. So we operate under a very specific government mandate under an EIFC Act. And we have our own independent board, our own credit department and treasury team as well. There are about 50 or so export credit agencies across the developed nations, and those roles we've got is to help exporters and grow the export activities from our country. So in Australia, we provide financial solutions to those exporters, so be it via loans or bonding facilities, and I'll talk about that in a little bit more detail. But we also value the whole of the supply chain, and I acknowledge there's quite a few mining companies on the line at the moment that are probably interested in terms of what services we operate. So case example for WA in mining, we look after mining services industries quite a lot, and we provide integral solutions for them through bonding specifically in working capital facilities. So if you're a mining services provider to any of the end exporters, Rio Tinto, FMG, Roy Hill, you can be subcontracted, and when third or fourth removed, you can actually reach out to obtain funding from us. So we operate on very much similar terms and on commercial basis to a bank. So we do have quite an in-depth level of criteria for assessment. But we also work very closely with the form agents, and in fact, majority of our referrals are sort of shared to us by the banks where they're unable to fill those obligations or assist the clients. Part of our mandate is to not compete with the private market, and it is also to sort of assist businesses that are in the growing phases where they have struggles on their balance sheet when there's sort of lack of landed security, to grow them to a sizable transaction or sizable entity where the banks will potentially pick them up. So just moving on to the next slide. So who can we assist? Obviously, as noted, we can assist exporters and those in the supply chain. The focus for us on the ground here in WA is SME and middle market clients, and that's anyone turning over from 250 mil to 250,000 to up to 150 mil. So it's quite a big range for us, but we also have a large corporate and businesses transacting over 150 mil turnover that are managed out of our Sydney team under project and structured finance. So we're fully integrated export agency. So the parameters in terms of who we can actually assist are obviously direct exporters, supply chain, businesses expanding overseas, those businesses that are sort of looking to set up footprint, set up operations offshore, provide stock offshore as well. And, they already commercialise their product in Australia and established themselves. So the key criteria here is you have been commercialised for the last 2 years, you've got minimum turnover of 250. There is obviously reluctance for the private market and the lenders to support you. And as I mentioned, that's normally on the back of lack of tangible security, or lack of balance sheet strength as well. And then certain overseas markets that banks just do not want to play in and sort of refuse to provide support for. As Craig mentioned before, I think banks have a lot more comfort when there's domestic related transactions, and that's where we play an important role overall. We also provide overseas buyer debt. So a lot of clients that don't require funding from us utilise us in their tendering process overseas, where you've got a sizable business, PNG, Philippines and different countries, and they're willing to sort of buy your products, but they're struggling with raising capital. We can look at as Export Credit Agency facilitating funding for them. And additionally to that, government sovereign funding too. So recently, I think early or towards the end of last year, we have provided 300 million US currency to Papua New Guinea to assist them in providing and payments to Australian customers working over there. So that was effectively government-to-government sovereign debt. The biofinance example that we've got for WA is, you'll be familiar with Austral Ships, who are a manufacturer of large vessels and ferries to the overseas markets, and we have successfully been able to assist their buyers from overseas obtain funding from us. So how do we provide assistance? We are pretty simple, to say the least. We got really 3 core offerings as such. We provide direct assistance through direct lending, but we also work with the banks to provide assistance through the bank. And the facilities that we generally provide are loans or lines of credit, which are sort of traditionally pre-COVID would have been tied into an actual contract of funding. So we are very much a point-in-time financier, where you've got an overseas contract, let's say to Europe, and you're providing a bunch of widgets and you're needing working capital facility to fulfill those. It's a substantial order. We can assist with that, and we will map it out according to your cash flow. So we'll be in and out according to what your cash flow demands up front, which is sort of very important to have, and Craig sort of talked about that in quite a detail. Similarly, with the lines of credit, if you have multiple ongoing purchase orders with your overseas counterparties or contracts, we can look at funding a line of credit. Now, our line of credit is a very clunky product. You do need to provide a lot of sort of paperwork via email. We don't have a trade finance sophistication, which a lot of banks do. So as such, we tend to work with a lot of banks where we would provide a guarantee type product to them in order to facilitate a potential trade finance facility where that's a requirement, and there's a lot of sort of touch points to manage. So contract bonding for advance payments, performance and warranty is, like I mentioned, a key product for us in WA, especially with the mining services, due to requirements for procurement, engineering and commissioning contracts. And specifically, we are very much in competition as such with the bank, because predominantly we would seek a coverage of 20 to 30% cash cover, as opposed to 100% that the banks will be sort of needing, or landed security. So we do play quite an important role within that mining services space, and probably I would say 60 to 70% of our deals at present are bonding related or bonding limit related. And now I'm going to talk a little bit about the COVID-19 facility. So I'm not too sure what the impact to your business is at the moment. However, you would have seen in the media talk about our minister providing funding or additional arm of funding in addition to all the other government funding limits that they have imposed, and what the COVID-19 Export Capital Facility looks like. So our original key criteria for assessment, as mentioned, is very much tied into point-in-time financing. You've got ability to fulfill that contract. You know what your offtake is looking like. We're sort of very quickly in and out of those limits and negotiations. So for a lot of exporters at the moment, the struggles are that offtake has been removed from them. There's no certainty of what that's going to look like. A lot of overseas markets have been impacted. Delivery and obtaining stock from overseas is sort of questionable. However, it is opening up. And the projects have been delayed. So their offtake has been impacted quite significantly, and this is where this facility fits in. So the key parameters of this facility is obviously 2 years minimum trading. You needed to have $250,000 minimum turnover as well. You have been a profitable operation in one of the last 2 financial years. So we are sort of looking to provide support to those businesses that are operating really well historically. You know, they might have been gearing up for some overseas contracts. The impact has been quite severe. They have spoken to their bank. They've exhausted avenues through the banking lines. They are obviously speaking to governments in terms of other available avenues through JobKeeper. However, they need additional liquidity to get them through the next 3 to 6 months or 12 months or whatever that takes. So they're unable to seek financing from the private market. So the key here is for a lot of businesses, we're sort of encouraging that interaction with the bank, getting that support. Us to support you from that point on for repayments to sort of to 3 to 6 to 12 months where required, and have sort of ability to arrange some sort of balloon payment. Now, it's very difficult for you guys all to sort of establish, you know, how far and how long this is going to take and when things are going to be back to normal. But, you know, we have to start somewhere, hence the 2-year term of the facility, which we're hoping will assist in the short run. So the lending processes and risk assessment for us tends to be quite a bit of an in-depth process. The main reason for that is we don't have a privileged of secondary way out. And what I mean by that is we don't tend to mortgage property direct to security. We don't mortgage commercial property. We sort of tend to sit secondary to the banks, and the primary source of repayment for us is contract fulfillment and cash flow. So when we sort of look at lending transactions from our point of view, we sort of tend to go into quite a bit of detail. So apologies for a very busy slide, but as we are sharing this presentation with everyone, we wanted to make sure that we're covering enough detail for this is sort of relevant when you go and refresh back to it. So to take you through some key aspects, for us, we are a W business development team on the ground, and we are very much a conduit between yourself and your advisor and our credit department in Sydney. So what we really seek to understand is very quickly obtain information from you about science and quality driven information that we can present to our credit. You know, what is the impact to the business? What are you seeking? You know, what contract are we looking to support? Is it impact from COVID? And if not, we will treat it as a normal commercial application similar to what the banks are. So out of these slides, the key aspects of what Craig has already covered off is the financial risks. So being able to provide and articulate where your cash flow is. So just like cash is king, cash flow forecast at the moment is a very important tool for a lot of financiers to understand what the impact of COVID is, or if there is no impact, what is the business going to look like in 12 to 18 to 24 months now, even going as far as that. So more importantly, understanding from your point of view, because you are the ears on the ground, you are the expert within your sort of market area. What are your suppliers telling you? What are your buyers telling you? Where are you getting your information, and sort of how are you constructing this cash flow? So assumptions are very important in line with those cash flow forecasts as well. Performance risk is a key aspect for us as well in terms of ability for that business to perform their duties. And Craig, you've mentioned quite importantly sort of management capability. Who are the key personnel? You know, what do they do? What is the business experience? What historical contracts have you done and being able to execute you know, within a timely manner? Has there been any issues that potentially could be flagged if we did a Google search on your company, what those look like? And you know, have you got your ATO in order? So we also look at overseas country environmental and social risks. So a lot of our companies have operations offshore. They do manufacture offshore, which does not preclude them from being able to obtain funding as long as there's an overall benefit to Australian operations and revenue stream coming back in here. So how are those businesses conducted overseas as well? What procedures and policies do you have in place? Is there any environmental impact on those? Again, buyer risk, we would look at understanding what those buyers are overseas. Who are you dealing and interacting on a regular basis or in hoc, and which countries are those transactions conducted in? So again, with our structuring of our facilities, we tend to sort of take a secondary position to a bank. So we would be a second GSA holder with a lot of those transactions where there is a primary lender involved. And we would also not seek to take a mortgage over property either, and we will be taking direct to security. So that is our sole way out and ability for you to perform on this contract is the repayment and how we actually get it repaid out. So I'm sure there might be a few questions about this slide, but yeah, so in terms of our processes, we would generally have a discussion with yourself, what your needs are, collect a prospect profile based on data and information provided by your accountant, by yourself, your CFO, in terms of historical performance and the need. Where that fits our parameters, we would issue you with an indicative term sheet, which will dictate the terms of the funding, what the pricing is and the security. And the more in-depth process for us is that due diligence or credit submission, which covers a lot more of a in-depth information under these key risks noted below. So a final slide sort of talks about a little bit more around WA clients we have recently supported. For privacy reasons, we can't disclose their names, but I wanted to cover a bit of industries and a variety of industries we get to sort of work across. So we sort of become a little bit more experts across every single industry in WA, which is a fun job, a fun part of the job. So drilling consumables client, which I mentioned before, so these clients are sort of a scale-up opportunity. They've been operating for 2 years and just slightly profitable, but managed to secure a very large contract in PNG. All of their manufacturing is done in China on the back of a collaboration and some IP of some very unique products that they have developed. So part of our job and the interesting part of our job is, seeing the innovation that comes out of WA, which has been very exciting over the last sort of year or so. So these guys manufacture overseas, provide to Papua New Guinea a bunch of consumable products on an ongoing basis. So we were able to provide him a working capital facility to assist with his stock management. Another one we sort of talked about is glamping tent manufacturer. They service a lot of the exporting markets. They've got a really unique and desirable product overseas. The next ones we've got is very much sort of renewable energy and engineering and construction companies. As mentioned before, a majority of these are contract bonding requirements where we would put a bonding limit to support them for their advanced payments, performance and warranty bonds at a cash coverage of 20 to 30% versus 100% that the banks would be seeking. A lot of oil and gas equipment supplier, they needed a working capital facility to acquire overseas manufactured capital equipment. So as you would know, a lot of banks were very shy to provide any funding for anything that's managed and sort of manufactured offshore for the control purpose of it. They tend to cover that through a letter of credit, which would require on the back end some sort of security. This particular client didn't have any of that, but he had the right expertise and we knew who the supplier overseas are, so we can get comfortable with providing working capital. Until the machinery arrived, he was commissioned, and then a bank would generally tend to pick it up because it's sort of a product that you could actually fund against equipment funding. Again, so Drillcore specialised engineering equipment. They were provided with equipment lending loan and working capital loan to sort of fulfil their requirements here. And an interesting one is contact lens manufacturer and global supplier. So they're undertaking overseas expansion and or seeking working capital funding for increase in stock and keeping stock offshore. Just on a final slide, there is a bunch of resources that you may like to access on our website, which we're constantly updating, and it's got a lot of economic updates as well. It talks about expanding overseas, and a lot of those clients that we are sort of assisting with export conversations are referred there. There is the ability to apply for a small business loan online up to $350,000, which is sort of a much more expedited process, and there's a link and contact details for that if you're sort of thinking you might be in the space to that you want to tap into. And of course, the lovely disclaimer that we sort of tend to gloss over, and leave on there lingering for a little bit for everyone to read. So yeah, that concludes my presentation, Aaron. I wanted to really thank you for your time, and I trust the insights that were shared today will add value to your business in your next funding negotiation. I will pass back on to Kelly for Q&A.
Thank you. Thank you very much, Craig and Aleks, for that very informative presentation. We have a small amount of time left now for questions. So if there's anything you would like to know, please type your questions into the Q&A box at the bottom of your screen. Just wait a couple more seconds. We don't have any questions just yet. No? Well, I guess this means that Craig and Aleks have done a very good job in covering off this topic. So thank you again to you both. Oh, sorry, we've just had one question come through. Craig, this is potentially for you, but Aleks, apologies if you want to jump in and answer this one. We have a question. Is there any merit in getting a mortgage broker to assist with a loan application?
Yeah, I can take that one, Kelly. Look, I think it's definitely worth getting an advisor of some description involved in the process. I do, part of my role is to do pre-lend due diligence for the major banks, where we will effectively they outsource their due diligence assessment to us. And one of the things I find through that is that a well put together submission certainly saves time in the long run. So where the banker gets comfortable and the credit team gets comfortable that the and me as a due diligence provider can get comfortable that there's been a lot of thought put into the application. The application's well laid out and understandable. That really speaks to the credibility of the business and the ability of the lender to provide the funds. Where that's not the case, what we find is the processes seem to drag on quite a lot, and through the process, sometimes the lender can lose a little bit of confidence in the underlying business. So look, I would advise that you get an advisor on board. Now that might be an accountant to assist with that, who knows your business very well. That's something obviously we do regularly for clients in terms of pulling together these submissions and assisting with the financial modelling aspect of it as well. So I think it's a really good idea to get a financial advisor involved.
Thanks, Craig. And just following on from that question, the same person has asked, do you have any feedback on what the success rate for loan applications have been so far for the 250k loans?
I'll just double check. So Sam, are you meaning the 250k loans that have sort of been allocated to the banks, or the new COVID-19 through Export Finance Australia? I believe that the bank loans. Okay. So with the bank loans, the feedback has been a little bit mixed. I think they've been all quite busy sort of scrambling and trying to, deal with influx of issues, but they are pretty much treating everything as business as usual in terms of criteria. And we've had some successes with clients obtaining it. And obviously we had some that haven't been so successful and that have sort of reached out to us. I hope that answers your question, Sam. So it's a bit of a mixed bag.
Thanks, Aleks. I have another question for you, asking if you can provide any commentary on the level of supply chain disruptions you are seeing from your client interactions. I note the ACCC is now allowing mining companies to share info in relation to stocks of equipment and mining supplies.
Yeah. Hi, Daryl. To be honest, it's probably not something we have really been made aware of. Supply chain does play quite an important aspect for our exporters, and just today we were sort of talking to deep hurt and issues they're experienced from their exporters' point of view in terms of delays of letters of credit, inability to negotiate with India at the moment, with DHL not sort of shipping documentation. So at the moment, disruption to supply chain are very visible and obviously known to everyone, and we are scrambling as a government to sort of put processes in place. But particularly for Export Finance Australia, we haven't seen anyone specifically approach us to say they're approaching us because of the supply chain disruptions. It's more around inability to obtain funding, offshore contracts being delayed, and inability to further negotiate with sort of some of these close countries which are slowly starting to open up. Hope that answers the question, Daryl.
Thanks, Aleks. I'll wait a minute to see if we have any more questions from our attendees.
While we are waiting, I'll just add to the broker question, mortgage broker question that was there before. I'm actually dealing with a business at the moment, which is a COVID impacted customer within metal recycling business. And what's worked really well is having themselves, their accountant who's based in Melbourne and the broker who's based in South Australia all work really together to sort of put condensed, concise, relative information to us as a package. So, so there is definitely merit in sort of everyone working together and putting the client's best foot forward.
Thanks, Aleks. I can't see that we have any more questions, so unless anyone has anything that they would like to ask, we can probably wrap that up. We will be collating all of these questions and Craig and Aleks will answer them in greater detail for you all. These will be circulated in our post-event communications email along with a recording of today's presentation. So make sure you keep an eye out for this in your inbox over the next few days. Thank you very much for joining us today. Stay safe and we hope to have you back for our next CoSec Confidential event, which is taking place at the end of May. Full details of this webinar will be released in next week's CoSec Confidential newsletter, so make sure you keep an eye out for this also. Thank you all very much.
Thank you.